Greetings, comrades. This video complements some other videos that I've created on the financial indicators component of the VCE course. So you can check those out, care of the playlist that I've created. I'm going to have a video for each of the 12 financial indicators in the VCE accounting course. So ROI is one of the 4 profitability indicators that we have in the course, along with return on assets, GPM, and net profit margin. And as I've outlined in the other profitability vids I've made, profitability and profit are not the same. When you're asked to evaluate profit, you are simply looking at the bottom of your income statement in terms of your revenue minus your expenses. But when you're asked to evaluate profitability, you are comparing profit, whether it's gross profit or net profit, to a base figure, in this case, average capital or owner's equity. So importantly, you will need to memorize the formula on this. Return, well, that's our numerator, which is net profit. And the owner's investment, well, that's our average capital. It says here, according to page 13 of VCAR, that we express this as a percentage. Now, we'll walk through 3 examples with this, but as stated on my other financial indicators vids, we take a 3-step approach in terms of how we structure our response, starting with a definition of the indicator. Then we evaluate the trend for the other indicators, and we can do that here, or alternatively, we can compare our ROI to alternative investments. Now, stay tuned for example number 3 on that one. Then the higher order thinking comes into play when we draw on the data to unpack what's caused the change in the ROI. So our 3-step approach for example 1, a simple definition is your starting point. It's a measure of the return of the owner's investment of funds into the business. Step 2, we discuss the trend. So in year 1, we returned 25 cents of profit in every dollar invested by the owner, and then we declined to a 20-cent return. So we emphasize that this is an unfavorable trend. We unpack that in both years, we've generated 20 cents or 25 cents in year 1 for every dollar invested. So we draw on that data. Now for step 3, we unpack what's caused the trend. Now usually, or what you'd expect when we have a decline in the ROI, is that there's been a decline in the profit, but not so here. So if we actually look at the profit, we've had an increase. But if we look at the average capital, we've had a much bigger increase proportionally. So how do we unpack this in words? Well, check out step 3, my wording here. So we've actually got the calculator out and measured we've had a 20% increase in profit from one year to the next. So a $10,000 increase, we divide that by 50K, and that's a 20% increase if we get busy on our calculator. But if we look at the increase in our average capital, that's gone up by 50%. So half of 200,000 is 100,000. So we've gone from 200,000 to 300,000. That's a 50,000 increase. Why? Well, there's only one possible explanation. The owner's made a large capital injection. Maybe they've purchased an NCA and they didn't want to go into debt. So therefore, the owner has had some capital. They've injected it in order to expand the business. So be careful here. When you are evaluating it, make sure that your explanation is congruent with the information in front of you. So here's an opportunity for you to have a crack at the 3-step approach for evaluating example 2. So by all means, freeze the screen now. And now we'll get underway at tackling this one. So I'll skip my explanation of the definition, same definition as example 1, but let's have a look at our trend, because this time we're going in the opposite direction. We've gone from 25 cents return in the dollar on the first year, increasing up to 30 cents in the dollar on the second year. And so again, we need to have a congruent explanation that unpacks why our ROI has increased, because again, You'd think that if our ROI is increased, we would have had an increase in our profit, but again, not so. We've gone from 50k in year 1 to 45k in year 2. So that's a 10% decrease. We've dropped off 5k. So 5k divided by 50k means that we have a 10% drop. But then when we look at our average capital, it's gone from 200k to 135. So if we look at that difference, 65k, and we divide that by 200k, that's a 32.5% decline. So proportionally, that 32.5% drop in our average capital is more significant than the 10% decrease in your net profit. So what's caused that? Well, the owner's been greedy, taken out a high level of drawings. Maybe they've taken out drawings as a wage if they're a small business, and so therefore the owner's residual claims on the assets have reduced. Now, here's one where you'd say this is actually not totally favourable, because even though the profitability indicator has increased, we've got a double whammy here. The net profit is down, and also the owner's claims on the assets are also down. So even though it's a favourable increase in the ROI, it is not a favourable outcome for the business. Now, I'm not saying that a question like this would be on the exam, but it is a new study design in 2025, and so therefore we need to be prepared for obscure questions. So if we look at this question here, we've only got 1 year's worth of data. We're not really given a lot of information, but if we look at the additional info down here, the owners invested 200k in the business. They're not involved, so in other words, they don't draw a wage. And just as a very useful FYI, the major banks are offering an interest rate of 4% on a term deposit. So therefore, when we evaluate the ROI on this investment, we'd go, well, if the owner pulled out those 200,000 funds, they'd get quadruple the return in a risk-free investment, given there's no risk pretty much with banks. So economics students, you've learned all about opportunity cost. So the opportunity cost of investing $200,000 into the business is that loss of the extra 3% return, or $6,000 in terms of profit on an alternative investment. Now that's just a 1 year trend. For all we know, this business might take off in the next few years, but when we're just evaluating 1 year's worth of data, this is a poor result compared to alternative investments. And the ROI is the only indicator where this comes into play in terms of evaluating what's out there in terms of the market.